Hello. In this video, we're going to go through partial year depreciation, asset dispositions, and retirements. We've discussed in previous videos about various depreciation methods, which is how companies allocate the cost that they initially capitalize for fixed assets, for long-term assets that are revenue generating. And there are three primary ways to depreciate methods: the straight line method, the accelerated method, and units of production methods. If you are unfamiliar with any of these methods, please go back to a prior video discussing different depreciation methods. So far, what we've been talking about and what we've been calculating is when we acquire an asset on 1/1/X1 and it has an X number, of useful lives or service lives, and then calculating the depreciation. However, most of the time that doesn't happen. Companies purchase and sell assets on days other than January 1. So this is what this video is about. But some companies, just for ease, use what's called the half-year convention, where in the year of acquisition, when they acquire a company, a full half year's depreciation is recorded, and the other half, the second half, is recorded in the year where they sell it or dispose of it. And rather than taking the accurate exact number of months to depreciate it, they just use 6 months. Let's go through this example that we've gone through in different videos. But in this video, on April 1, Hover Manufacturing Company purchased a machine for $250,000 with an estimated residual value of $40,000, service life of 5 years, and estimated production of 140,000 units. Note, here, they acquired the machine on April 1. So far, for previous videos, the purchase date was on January 1. So let's see what happens. Let's just quickly go back to this slide that I've used before. And this is using the straight line method for the same example of what the depreciation would look like if a company acquired this asset on 1/1/X1. The depreciable base was 210,000, and the depreciation rate was 1/5, because year one we're depreciating for 1 out of 5 years, giving us depreciation expense of $42,000. So let's go through it of what happens when we have what's called a partial year depreciation, because in our new example, the asset got acquired on April 1 of X1, or of 2027, I guess, of 2027. So what happens is you take your normal $42,000 that you calculated up here, right here, what you calculate your depreciation expense for the full year, but then you only depreciate, this is $42,000 per year. What we have to depreciate in year one is we have to, from April 1 to 12/31 is the depreciation expense we get to take, which equals 3/4 of the year. Or you could say it equals 8 out of the last 12 months, which equals 3/4. So that's why you multiply 3/4, and under straight line, you get depreciation expense of $31,000 in 2027. And then let's fast forward to the 5 years, 2032. Still, you take the annual 42,000, and this is where you make up that year. You multiply the last, in the last year, you multiply by the remaining amount of months that you did not depreciate in that initial year, which in our case was 3 out of the 12 months, or 1/4. So just going back here real quick, and so when you look at your depreciation for the 5 years, year one is 31.5, and then you have your 42, 42, 42, 42, and then you have, it ends up being year 6, right? Because this is 1, 2, 3, 4, 5, 6, although because we started in 2027 April, it filters back into 2032 that you also need to take some depreciation expense for the first 3 months of the year, and that would give you 10,500. In total, still get depreciation expense of 210,000 versus when you take, just assuming it was purchased on January 1, you still in total get depreciation expense of 210,000. Now we looked at double declining balance previously and what the depreciation expense would be under that situation. And in year one, we calculated depreciation expense of 100,000 because it was the cost of the assets 250 times the depreciation rate is 40. And that was 1/5 times 2, which equals 2/5, which is the 40%. Let's see what happens when the asset is purchased on April 1. So, sorry, we're going to look at this column right here. So on April 1, if it's purchased April 1, you take the cost times 2/5, so this is the 40% rate, times, again, 3/4 because you're only depreciating from 4/1/27 to 12/31/2027. Now, in year 2, right, because this is double declining, you're going to go through that whole, like a table like this. And when you go through it using this depreciation expense for year 1, you're going to end up finishing your depreciation in 2030, in year 4, and because at that point, your ending book value is going to equal the residual value, which at that point you have to stop depreciating. And so again, we just get total depreciation expense for 210,000. Moving on to units of production, when we look at the example, if I go back up here, when you look at the units of production, and even though you just kind of look at, we acquired this asset on April 1, and from April 1 to 12/31, we produced 16,000 units. So we would go through the same units of production calculation, which ended up being $1.50 per unit. And for 2027, we multiply it by 16,000 and work through the table the same way as we did in the video for showing depreciation methods. So this is what, if I'm going to draw a line between these 3 different methods, this is the units of production method and what it would end up. Again, total depreciation expense of 210,000. So let's go on and talk about dispositions. And when we say dispositions, we are talking really about a sale of a long-term asset. Typically, when an asset is sold and a company receives, it says consideration receives, typically that's cash, but it could be something else. A company could give you land in exchange for this asset that they're purchasing. They could give you some of their accounts receivable in exchange of this asset that they're purchasing. But for now, we're going to call it cash. So you get cash, and whatever the selling price is compared to the net book value, to the book value of the asset that you're selling, you'll either have a gain or a loss for the difference, and it will be recognized on the company's income statement. So here you can see there's going to be a selling price less the original cost of the asset minus its accumulated depreciation. So this is their book value, and then you calculate the difference between your selling price and the book value will equal either a gain or loss on that sale. So let's go through this example. We have the same example where we have an asset that costs us $250,000, purchased on January 1, and the residual value is $40,000. Now, suppose Hover decides not to hold the machine for the expected 5 years, but instead sells it on December 31, 2029, which is 3 years later, for $140,000. We need to update depreciation to the date of sale. That's step 1. If anything, Step one is always, you have to always update the depreciation for the date of sale. So since the depreciation for 2027 and 2028 has already been recorded in those years, we need to update depreciation only for the current year of 2029. Okay, and this is assuming a straight line depreciation. So, which is how we have that 42,000. So we have to debit depreciation expense 42, credit accumulated depreciation 42,000. Let's look at our accumulated depreciation T account, right? When we first acquired the, this is just an asset or a machine. When we first acquired the asset in 2027, it had a cost of 250,000. So we would have debited the asset $250,000 and credited cash. And then at the end of year one, when we record this entry every year for 2027, 2028, and now for 2029, the depreciation expense goes on the income statement, but the accumulated depreciation is a contra asset account, right? Which means its normal balance is a credit balance. And each year we're going to credit 42,000 so that the accumulated depreciation on it is $126,000. So when we look at the items on our balance sheet related to this asset, we're going to have equipment for 250 and accumulated depreciation for 126,000, which we're going to have to write off, and because we're selling it, so we need to take it off our books. And the way we're going to take it off our books is here for the asset, for the equipment, we have a debit balance of 250,000. We're going to have a credit of 250,000, and for accumulated depreciation, we need to take that off our books. Currently, we have a credit of 126,000, so we're going to debit it for 126,000. We're going to debit our accumulated depreciation. So let's look at that. So here we have our debit for the accumulated depreciation for 126,000. We have a credit to equipment to take this off of our books for 250. The problem tells us we received cash for 140,000, and you have to make this journal entry work. And the way you do that is you have a credit balance that's needed, which means it's a gain on the sale of equipment. And the gain is calculated to be the selling price, which is right up here. So when you go up here, the selling price of 140 minus the book value. The book value is going to be the cost minus accumulated depreciation, which gives you 124,000, and that's how you get your $16,000. Let's take the same example, except now we only received $110,000 for this asset, which results in a loss because we're going to take cash. The selling price, right, is 110,000 minus your book value, and the book value is your cost minus your accumulated depreciation, which is 124,000. So 110 minus the book value of 124 makes it a loss of $14,000. Our entry is going to be, again, we're going to debit our accumulated depreciation for 126,000. We're going to credit our equipment balance for 250,000. We received $110,000 in cash, so we're going to debit that. And then essentially your entry is going to be off balance, and the way to balance it is you're going to need a debit, and that debit is going to be called loss on sale of equipment for $14,000. Quickly, let's just talk about the gains and the losses. When you sell an asset where the gain or loss is calculated as the selling price minus the book value, right, equals the gain or the loss on the asset, that just means that, if it's a gain, you sold it for more than its book value, and if it's a loss, you just sold it for less than its book value. Let's talk about gain. That net increase, when you record a gain in your income statement, it's just a book gain. It's an accounting gain. It's not it's not economic gain. Meaning you do get the money for it, but that gain is not based on the fair value of the asset that you sold. It's based on the book value. So that's just something to keep in mind. Retirements, sometimes companies may retire an asset instead of actually selling it. They just want to get rid of it or they give it away, whatever, they donate it, whatever it is. Actually, not donate because that's a different type of entry, but they just get rid of it. And so they just need to remove the asset and the corresponding cumulative depreciation from their books, and then they have a loss equal to whatever book value is remaining. So let's just say we we had that book value, that asset where it cost $250,000 and the cumulative depreciation was $126,000, right? So the book value is what? 124,000, right? That's the book value. The entry to that is going to be when you retire it, since there's no cash involved, you're going to debit your accumulated depreciation for 126,000. You're going to credit your equipment or your asset for 250,000, and that 124,000 is going to be a loss. It's going to be a loss on retirement of asset. Retirement of asset, I'm just trying to fit it all in, and that would be $124,000. So you have no cash, but you still have to record a loss. So anytime you have a retirement, you're going to have a loss unless that asset is fully written off, right? If our cost is 250 and our cumulative depreciation, it's after 5 years is 250,000 and our book value is 0, then there's no entry to be had.